You are about to watch a recording of the 2021 Catholic Foundation Investment Forum featuring Invesco's Chief Global Market Strategist, Kristina Hooper. If you have any questions at the end of this recording, please contact the Catholic Foundation of North Georgia using the information at the end of the video, or visit our website at cfnga.org.
Good morning to everyone and welcome to this investment forum. My name is Father Henry Atem. I'm a member of the board of directors for the Catholic Foundation. I'm also the chair of the Pastors Advisory Council, and also recently I was asked to chair the Catholic Emergency Response Fund Grants Committee. And I'll talk a little bit about all of this when I give a little brief reflection as we begin today's event. I'm assuming that most of us or all of us are Catholics. If we're not, I'm a Catholic priest. It is a Catholic foundation, so I'm going to pray in a rather Catholic way. So we shall begin with the sign of the cross in the name of the Father, and of the Son, and of the Holy Spirit. Amen. And I'd like to begin by reading a passage from St. Matthew's Gospel. Jesus said to his disciples, "It will be as when a man who was going out on a journey called his servants and entrusted his possessions to them. To one he gave 5 talents, to another 2, and to a third 1, to each according to his ability. Then he went out. Immediately the one who received 5 talents went and traded them and made 5 more. Likewise, the one who received 2 made another 2. But the man who received 1 went away and dug a hole and buried his master's money. After a long time, the master of those servants came back and settled accounts with them. The one who had received 5 talents came forward, bringing the additional 5. He said, 'Master, you gave me 5 talents. See, I have made 5 more.' His master said to him, 'Well done, my good and faithful servant. Since you were faithful in small matters, I will give you great responsibilities. Now come and share in your master's joy.' The one who received 2 talents also came forward and said, 'Master, you gave me 2 talents. See, I have made 2 more.' His master said to him, 'Well done, my good and faithful servants. Since you have been faithful in small matters, I will give you greater responsibilities. Now come and share in your master's joy.' Then the one who had received the 1 talent came forward and said, 'Master, I knew you were a demanding man, harvesting where you did not plant and gathering where you did not scatter. So out of fear, I went off and buried your talent in the ground. Here it is back.' His master said to him in reply, 'You wicked, lazy servant. So you knew that I harvest where I did not plant and gather where I did not scatter. Should you not have put my money in the bank so I could have got some interest on my return? Now then, take that talent from him and give it to the one who has 10. For to everyone who has, more will be given, and he'll become rich. But from the one who has not, even what he has will be taken away.' And they threw that useless servant into the darkness outside, where there will be wailing and grinding of teeth." Let us pray. Almighty and gracious God, on this day as we gather now as members of your household, listening to your word, but also opening up our hearts to the dictates of your commandments, we ask you to bless each one of us to emulate the example of the 2 servants who saw, first of all, the talents in their lives as gifts from you. And in response to that generosity, they went and they invested those talents. We ask you to bless all the men and women who gather here this morning as we gather now to discuss different ways in which we could improve our lives and improve our society. We ask you to bless each one of us to have the right disposition and the right attitude. And may we see every gift in our lives as a talent entrusted from your generous and your providential hand. All this we ask through Christ our Lord. Amen. And so I'd just like to briefly meditate, share with you all briefly about my connection to the foundation. Being a priest, this may be 13 years, and I've worked with the foundation for maybe the last 7 of those, served in different capacities in the foundation. But just going back to the gospel reading that I just read for you all this morning, I see as a priest, I see the many talents that I have as a gift from God. That God has given us so many different talents, and that we have a responsibility to respond. Responsibility comes from the word response. That we have the responsibility to be able to give back to God in a special way within our society, within our world, all that He has given to us. That we have a responsibility to make a contribution. So I'm very grateful to Nancy, to Juliet, to Leslie, to all the members, John, and all the members of the Catholic Foundation, because I see in them every day this kind of an awareness, this kind of a consciousness that God has entrusted to us so many gifts, but that our lives will only be most meaningful when we're able to use those gifts, not only as a response to His providence, but also as a means by which we continue to try to enhance the world around us. So recently we started the Catholic Emergency Response Fund, especially at this time when so many people are struggling from the consequences of the pandemic. And I think that in every little way, in every small way, every one of us is able to heed to those words of Jesus Christ. Whatever you do to the least of your brothers and sisters, you do for me. And I think that through our work in the foundation, we have been able to respond to that summon of Christ. And I pray and I hope that each one of you on this forum today will be able to take something home that will help you to try to be, as St. Paul tells us, to try to strengthen the body of Christ. And that every one of us, through our own desire to continue to apply ourselves to the gifts that God has given us, to the talents that God has given us, now be able to enhance the state of the human society. Thank you.
Thank you so much, Father Henry. So I want to also welcome you again to the Foundation's 2021 Investment Forum. My name is Nancy Dinka Coveney. I'm the president of the Catholic Foundation of North Georgia. The Catholic Foundation is the place for Catholic philanthropy in the Archdiocese of Atlanta. We help Catholics like you make a lasting difference by serving as a catalyst for gifts of all sizes and assets. These gifts are primarily to endowment funds and donor-advised funds, both now and in their estate plans. We work with local Catholics and their advisors to facilitate the most tax-advantageous gifts to create their Catholic legacies. The endowment funds are invested and managed to ensure that the ministries and the Catholic community have the resources they need to serve current and future generations. Our list of products and services includes endowment funds, donor-advised funds, charitable gift annuities, plan giving services, online will and estate planning tools, grants programs, I Give Catholic on Giving Tuesday, legacy planning workshops, and the Professional Advisors Network. If you wish to learn more about our services and how we might assist you or your clients, please go to the Catholic Foundation website or contact Juliet Greco or me directly. Thank you to those who submitted questions at the time of registration. We have pared them down for today's question and answer session. We will seek to address questions that are specific to the Foundation services as a follow-up, but feel free to reach out to us directly too. We're grateful to Kristina Hooper for agreeing to again speak at our investment forum this year, and also for the support of Marty Flanagan and Invesco. I also wish to thank the other speakers who are assisting us with the webinar today, all of whom are board members of the Catholic Foundation. Father Henry Hatem, who you just heard, is the pastor of St. Lawrence Catholic Church. He is the chair of the Foundation's Pastors Advisory Council and is also the chair of the Catholic Emergency Response Fund Grants Committee. John Rapole is a senior vice president and wealth advisor at Wells Fargo Private Bank. He is the chair of the Foundation's Grants Committee, a member of the Catholic Emergency Response Fund Grants Committee, and a member of the Professional Advisors Network leadership team. And Jody Foster is president of Symphony Consulting LLC. She too is a member of the leadership team of the Professional Advisors Network and is also a member of the Foundation's Finance Committee. Juliet Greco, the Catholic Foundation's Director of Major and Planned Giving, will wrap things up. So yes, we have a lot to learn in an hour. I thank you for joining us today and will now turn it over to John Rapole.
Good morning, everyone. Thank you so much for joining us. Just want to talk a little bit about what we do about the foundation in general. So, Leslie, could you go to the next slide, please? Great. So, who we serve, we benefit 200 plus organizations, 1.18 million Catholics, and 107 parishes in North Georgia. And how do we do that? So we don't want to lose focus. As Nancy said, I chair the grants committee, and the reason that we are managing these assets and are great stewards of these assets are not just for the sake of getting a good return, but for the good work we do in the community. And so we have distributed $2.4 million in just this fiscal year in grants for various causes, mainly Catholic causes, but many causes across the board that support Catholic teachings and Catholic philosophy. So just want everybody to keep aware by entrusting your assets with the Catholic Foundation. We not only do a great job of being a steward of that, but it eventually gets to the people in need that our Catholic faith teaches us that we need to serve. So just some history on the growth of the foundation. I have been on the board for close to 10 years now. It's unbelievable how time flies, but the growth of the assets, we managed roughly 45 million in the fiscal year 13-14, and now we're bumping up against 100 million. I think we'll get there by the end of this fiscal year, which is in June. So it's an unbelievable, basically a doubling in the assets in the last 7-8 years. So it's unbelievable, not only a result of the fantastic stewardship and investment, but additional gifts from our constituents and our supporters. So thank you. And here's some more granular details on the specific performance of our long-term growth strategy, which is mainly an equity focused strategy that we change the equity allocation as we see the market as the market dictates. But our 1 year performance is 11.65, 5 years 9.63, 10 years 7.47. So it is fantastic, very, very market competitive performance, and given once again, we are not 100%, even in our long-term strategy, we are not 100% equities. We have a very, very low volatility and a lot of fixed income in the portfolio as well. So it's a very, very good, good mix for long-term growth. And so with that, I would love to introduce Kristina Hooper, who is the Chief Market Strategist for Invesco. Kristina is entered the financial industry in 1995. Prior to joining Invesco, Ms. Hooper was the U.S. investment strategy of Allianz Global Investors and held various positions at PIMCO, MetLife, and she has regularly been quoted in the Wall Street Journal, New York Times, Reuters, and was featured on the cover of Kiplinger's magazine in 2015. Ms. Hooper earned a BA cum laude from Wesley College and a JD from Pace University School of Law, where she was a trustee's merit scholar. She earned an MBA in finance from NYU Stern School of Business, where she was a teaching fellow in macroeconomics and organizational behavior. And she has a master's degree from Cornell University of industrial and labor relations, where she focused on labor economics. Ms. Hooper is a certified financial planner, a chartered alternative investment analyst, a certified investment management analyst, a chartered financial consultant, and she serves on the board of trustees of Our Children, and previously served on the board of Jefferson Insurance Company. So with that, we are glad to have Kristina here again, and we look forward to her comments. Kristina?
Thank you so much, John. It is such a pleasure to be with everyone today. Now, of course, last year I had the great pleasure and privilege of being with you in person. It's been a very different year, and so I think you get to see a little bit of me, warts and all. So I apologize already for the sloppy office. This also doubles as my television studio. You can see I've got a special light back there. And of course, my kids do their homework in here often when they need to be supervised while I'm working. So it's a whole different world. And in fact, I think that's really how I want to start this presentation, is to talk about how different things are than they were a year ago. We didn't know what was going to hit us, and hit us so hard. When I spoke to you last February, I was following very closely COVID-19 spread through Asia as well as Europe. At the time we were meeting, there were already lockdowns going on in Europe, and of course, then COVID-19 hit the United States. We fell into a very significant economic downturn that we are still climbing out of. And so this is a very unique year in that there are so many more variables to the macroeconomic outlook. And we have all needed to become amateur epidemiologists and health professionals just to try to understand what's happening and how it will impact our economy this year. So I have to say, though, that we did get a huge game changer in November, which was the announcement that Pfizer, that actually several pharmaceutical companies had developed effective vaccines. Now, keep in mind that as recently as last summer, we were hearing from medical and health professionals who were very skeptical that they could come up with an effective vaccine for a coronavirus, just given the history of trying to protect against coronaviruses. So this was an incredible breakthrough, especially with the effectiveness level that they were at. Over 90% was not what was expected. The hope had been to get something that was effective at about 70+%. So while we've been through a terrible year, and there's still a lot of damage to the U.S. economy, as I look out, I'm very positive actually about the economic recovery. That doesn't mean we aren't going to go through headwinds first, but I think once we do get that broad distribution of vaccines, we could see a strong rebound. So rather than talk endlessly, let me start taking you through the slides. So if you don't mind advancing to the first slide. What you will see is something that we're tracking very closely, which is the 7-day average daily confirmed cases per 100,000. And what you see is that while we did see a very big surge over the holidays in both the US and the UK, that curve has been very, very successfully bent. Now we do know, and in fact, even deaths have come down significantly. Typically, there is a several-week lag between infections and deaths, but we follow both closely, of course, with a focus on the infections. If you turn to the next slide, you'll just see the inclusion of other countries here, and this gives you a sense of just the overall cases. And what this tells me is that some countries have been better able to manage the virus than others. A lot of it has to do with experience. Keep in mind that in Asia, this is not the first recent pandemic. We've lived through SARS and a few other pretty significant contagions. And so there, I think, is an infrastructure, and certainly an infrastructure was built upon in this pandemic that really effectively controlled the spread of the virus in countries like South Korea, Japan, and China. So that just gives you a sense of I think, which countries have been impacted the most from an economic standpoint, because the more easily it has been to control the virus. Typically, the more fully a country has participated in an economic recovery. And I'll go into that in a minute. But if you turn to the next slide, you'll see the United States broken down by region. And it's clear that what I would call the third wave, the one that we've seen over this winter period, has been the most severe for all regions. And you can see that certainly the Midwest and the South were hit harder. But having said all that, we have developed some effective treatments. We've learned a lot from really the first wave. And so that did mitigate deaths, thank goodness, to a certain extent in that third wave. But what we focus on for the purposes of lockdowns is hospitalizations. And on the next slide, you'll see hospitalizations. And they, of course, not surprisingly, grew. Now, if you look at hospitalizations, you'll see that they came down relative to the number of infections in the third wave because we've become better at treating it. The medical profession has learned a lot, as I said, from that first wave, but hospitalizations did still get high. And what happens is when you get to a certain level of hospitalizations, the healthcare system becomes overloaded. And so people who do have severe cases of COVID do not get treated well. Unfortunately, they just don't, medical professionals don't have the time to get them the best healthcare possible because they at times are rationing treatments, et cetera, in severe cases. And those are the kinds of strains we saw, for example, in Los Angeles over the holiday season. So this is important to follow because this is really what dictates whether or not mayors, whether or not governors need to impose lockdowns. As much as governors say they're not going to have another lockdown, and we heard a lot of that after the first wave, the reality is that there aren't enough hospital beds. If medical professionals, if hospital staffs are overwhelmed, then that's usually the trigger for a lockdown. If you turn to the next slide, you'll see that we did see significant lockdowns in a number of countries. Now, what I tried to do with this chart was essentially show the maximum level of stringency, the maximum level of lockdown since the pandemic began and relative to where we are today. And I should give the caveat, this is as of February 7th. So this is a few weeks old. Sometimes we can't get the most up to the minute data. But what it shows is that for a number of countries in that most recent period, they were at the highest level of lockdown since the pandemic began. Now, this shouldn't be a surprise if you're looking at economic data coming out of, for example, Europe, because it shows a significant slowdown, particularly on the services side. Because when an economy goes into lockdown, oftentimes manufacturing can still do well. It's the services portion of the economy that gets hit very, very hard. And so if you were to look at the ISM services data, for example, for a number of European countries, you'd see the pain, the damage that has been done because of lockdowns. A necessary evil, but again, something that we have to recognize can still happen again. If you're looking at this slide, what you'll see is new infections juxtaposed with stringency. This certainly gives you a sense, although I think hospitalizations are much more helpful in terms of guiding whether or not there have to be lockdowns, but infection rates can certainly be an early indicator. The stringency index is something that was created by Oxford University's Blavatnik School. And the idea is to just try to calculate the level of the lockdown, what has been closed, and that is that dotted line in terms of just how stringent precautions have been. And of course, we juxtapose that with new infections. It gives you some insight into what's happening. But again, hospitalizations are really key to predicting whether or not we'll see additional lockdowns. But those will come almost immediately after we see those hospitalizations go up enough. On this slide, you can see mobility. And mobility is an interesting concept, one that I had never really thought about until this pandemic began. But mobility gives us a sense of economic activity. Now, of course, it is not the be all and end all, because we can still sit at home, even in a lockdown, and order things on our laptops. That's the beauty of technological advancements. And so some economic activity continues. But certainly some economic activity is curtailed because we aren't as mobile. So we want to get a handle on mobility, because lockdowns don't tell the whole story. People can often self-quarantine, right? If you're reading the news and things look bad, or there are variants of COVID-19 that have emerged that seem more dangerous, you can make the choice to stay inside. And that's what people have done and are doing at different periods during the pandemic. So we like to get a handle on mobility, and we do that by tracking this. Google actually provides it and has been providing it throughout the pandemic for most countries. And this just gives us a sense. In particular, I would pay attention to retail and recreation. That's the dark blue line, because that gives us a sense of how much people are out and about, how they're, are they going to restaurants, that kind of thing, and the impact on the services industry. Now, certainly stringency has a lot to do with mobility, but as I said, it's not the entire story there. Now, if we were to dive down into the US, because that's global. Now, if you turn to the next slide, you'll see the US. And mobility is around 70% of normal. Again, this is a slight lag. This is as of February 7th. And I suspect if we had the numbers through the end of February, we'd see a pickup in mobility because COVID-19 infection rates are down. Now, I will just give the caveat that we do have now more contagious strains circulating around the country. And the US is behind other countries in terms of testing COVID-19 to see what kind of strain it is. So other countries have a much better sense of how much, for example, the UK variant is spreading, or how much the South African variant has spread in their particular countries. We know far less about those variants, but I suspect that we're going to see a pickup. Again, I have no medical training except what I've learned over the last year and sort of poring over a lot of this information. I would suspect we are going to see something of another wave. It's not going to be dramatic, I don't think, because we have done a good job with vaccinations thus far. But I don't think it's enough to stop the spread, nowhere near enough to stop the spread. So I think we could see another wave. Hopefully I'm wrong, but I think we could. If you turn to the next slide, you'll see mobility and essentially we use that as a demand proxy. So this gives us a sense of economic activity. And as you can see, mobility is down about 28% for developed markets. In the previous slide you saw for the US, it's down about 30%. But this gives a sort of a back of the envelope or sort of a guesstimate at what we're likely to see in terms of an economic impact. It's not precise by any stretch of imagination, but it helps us guesstimate the damage to economies. But as I said, the good news is we have vaccines that have been developed. And actually on the next slide, this gives you a little report card on the progress of vaccines. And you can see that we have 10 vaccines that have been approved. I think we are most familiar in the United States with Pfizer and Moderna. And actually after this slide was created, because this is as of February 8th, but we just got another vaccine approval in the United States. Less effective, but only needs one dose as opposed to 2. We have 20 that are in a large-scale efficacy tests. So a good portion of those are likely to move into the approval category. And then, of course, we have more in various phases. And as I said, Moderna and Pfizer have effectiveness rates of 90% or above, which is really, really impressive. And again, not what medical experts had expected. Their hope was to get something that was at 70% or a little bit above that. And again, I think that speaks to the potential to get economies and rolling again, and to again get individuals vaccinated. And we'll go over results in a minute. But first, I want to address that question of how much of the population do we need vaccinated to achieve herd immunity? And this gives you a sense of that. This actually chart we created based on research provided in the Lancet. The question, and we don't know the answer, but the best estimate from medical professionals who wrote the article in the Lancet is that anywhere between about 55.5% to 81.5% of a population needs to be vaccinated in order to achieve herd immunity. Now, that is obviously a very, very wide range. I think the hope had been that it could be on the low end of that range until those variants were discovered that are more contagious and suggest that we need to be closer to the higher end of that range. It remains to be seen. But I will tell you that I'm really encouraged by what is happening in Israel. They are the gold standard for distribution of this vaccine. And they're at a point where, and as you can see, Israel there is at almost 50%. And COVID-19's spread has slowed to essentially a crawl. They're reopening their economy this week. They're actually reopening entertainment, theaters, concert venues. Now they have reduced levels of capacity allowed. But this is really, really exciting. And I think is a case study in what can happen. Obviously, I'm going to follow this closely, but it seems like they've gotten close to achieving herd immunity with less than 50% of the population vaccinated. Now, I will tell you this number is as of February 17th. That's already a little stale, but it's the most recent numbers we have. We're following this closely. They're probably at 50% right now, just given the speed with which they've distributed vaccines thus far. So again, I know this is a lot of medical information. Usually you wouldn't expect to hear me talk about any of this in a macro market presentation, but this is the single biggest factor impacting the economic outlook this year is vaccines and really our ability to control COVID-19. So one more point about vaccines, if you turn to the next slide. We get a lot of questions about how quickly the world is going to be vaccinated. Now, why do we worry about the overall world? Well, there are a variety of reasons, but I would point to, from an economist and strategist point of view, obviously there are moral reasons, all kinds of things like that. But from an economist strategist point of view, you want to see the world vaccinated because it's a global economy. And really the single biggest creator of these variants is the uncontrolled spread of the virus. That's how variants, that's how mutations are formed. So we're a global economy. We want to ensure that, that we don't have mutations created. So we want to get the world vaccinated. And of course, we want to see emerging markets economies come back as well and flourish. So this just gives you a sense of where we are today. The vast majority of Western vaccines, which for the most part have been more effective, not entirely, you can go back to that vaccine chart to look more closely, but the vast majority of the Western vaccines are very effective, but they've been already secured by high income, what we'll call high income or developed countries. And a lot of emerging markets have been left out in the cold. Well, there is this global entity has been formed. It's called the COVAX Initiative. And the idea is to get countries to contribute to emerging markets. And so COVAX is essentially a cooperative that is collecting those vaccines and those pledges of vaccines and will distribute it in emerging markets. And we want to see that number grow again, because right now, according to medical experts, they don't expect emerging markets countries to be vaccinated in terms of broadly vaccinated, getting to the point of herd immunity until 2023. And that really creates a peril for the entire world. But of course, is a particular issue for them and would be a real problem in terms of getting their economies back, because every day that an economy is damaged is a day in which it builds up scarring that becomes harder to remove. So let's talk about the other components that are usually the vast majority of what I focus on when I provide a macro market outlook. Monetary policy. Well, there has been no shortage of monetary policy accommodation in the last year. In fact, after I left you last February, we saw stocks go down for about 6 weeks. There was a lot of fear going on. Markets were following what was going on in Europe, as well as what was going on in Asia in terms of the spread of COVID and shutdowns. And stocks really fell until the Fed stepped in and provided more monetary policy accommodation. Central banks have also been extremely accommodative. And so the backdrop, again, for this year is one in which we expect to see a strong economic recovery once people are broadly vaccinated. And we expect it to be supported by monetary policy, by continued accommodation in monetary policy. If you turn to the next slide, this will give you a sense. Just one quote from Jay Powell: patiently accommodative monetary policy. I think that's something we're going to hear more and more about because concerns are growing about inflation. We just saw the 10-year on the U.S. Treasury, the 10-year U.S. Treasury yield spike significantly. And that is in part due to concerns about inflation. Some of it, of course, is reflecting better growth expectations, which I think is right on, because I do expect that strong economic recovery. But there are concerns about inflation. And so Jay Powell's job over the last few months has been to calm fears about inflation and suggest that even if we see a spike in inflation, that the Fed is going to treat it as transitory and not act on it. Hence that term, patiently accommodative. Patient even if we see a big increase in inflation. And of course, we also have the potential for more fiscal stimulus. I should say that we've already seen significant fiscal stimulus. If you turn to the next slide, just to compare what we've seen now with what we saw during the global financial crisis, you'll see that this time around, this crisis, there has been far more fiscal support as a percentage of GDP. Now, that's not every single country, but as you can see, overall, especially if we were to look at the United States, it's far more. And again, this suggests an environment where there's less likely to be significant economic scarring and a stronger recovery. We also, of course, have seen that K-shaped recovery, where a significant portion of households, ones typically in white-collar jobs that were able to work from home, that didn't lose their jobs because they weren't tied to the service economy, have actually built up savings because they're not spending as much. You know, as we saw, that mobility is down about 30%. And so we have high levels of household savings. This all suggests a coiled spring where there's pent-up demand, money to spend. And as the economy recovers, I think we're going to see the service side of the economy open up, creating jobs. I think this is going to be a more job-full recovery than the last global financial crisis recovery, which was termed a jobless recovery. And I think that was about right. So just to quickly talk about implications, because I don't want to, I know I'm running a bit over, you know, the question becomes stocks or bonds. In this environment where we see the economy improving, and in particular where we see things like manufacturing performing well, we assume, and what has historically been the case, is that stocks have performed well. On the next slide, when it comes to cyclicals or defensives, and defensives is a category that includes Typically most of technology, consumer staples, those areas that tend not to be sensitive to economic cycles. Usually when you see an economic recovery, that's when you see cyclicals outperform. And that is actually what we've started to see. There is an anticipation that we are going to see a significant economic recovery. And again, I would agree with that. That doesn't mean you don't want to be well diversified. That's certainly not what my message is. I think we want to be very well diversified. But just know that, especially if you want to do some slight tactical overweighting or underweighting, cyclicals are likely to perform better just given their track record. Of course, I have to give the caveat that historical performance is no prediction of the future. We just can look to history as some kind of a guide. And then, of course, if you continue on to, and actually, if you keep going, I just want to make sure that small caps or large caps, typically small caps perform better and then large caps because they're more economically sensitive. And then finally, that the last market chart is emerging markets or developed markets. Typically, emerging markets perform a bit better or significantly better and have historically performed significantly better in a number of recoveries. Now, every recovery is different, and certainly some is dependent upon the US dollar and whether or not it's weaker. But we would, and especially the unique nature of this recovery, where emerging markets might not get vaccines until later, I think there are some question marks, but happy to explore that later. Just a few more thoughts before I finish this. If you turn to the next slide, you'll see some key themes that I just wanted to share with you. Now, one thing we saw with the pandemic was that it accelerated some key themes, in particular when it comes to technology and innovation. As I mentioned, more people work from home. Look, we're doing this all from home. And so that has increased the need for cloud computing. It's more about having the ability to use clouds in order to access software, in order to perform functions, in order to store data. And so that's just one of many trends that has emerged. And of course, I shouldn't say has emerged, has accelerated, excuse me, since the start of the pandemic. And I don't think that this goes away once the pandemic is over. We're already hearing that companies are considering more flexible work arrangements once the pandemic is over, just because there's a recognition that people can work from home, they can work effectively from home. Quite often they can work longer hours from home, which is always a good thing from a company's perspective, right? But that means the appropriate technology. That means the software. It means the cloud computing. We also have seen e-commerce take off. I've seen, just been fascinated with the big chunk of retail sales that is now attributed to e-commerce. It's more than doubled in the last year as a percentage of overall retail sales. No surprise there. Now, do I expect that to recede a little once this pandemic is over? Yes. But I think that many have found e-commerce, ordering more online, to be easier and more efficient. And so I don't think this trend goes away. It continues. Similarly, financial technology. I think that certainly accelerated during the pandemic as a necessity. People didn't want to hand over cash to others. Instead, they'd rather Venmo money to someone. And again, I think maybe that trend slows, but it doesn't go away. I think that's found to be very effective and efficient. And so that is, to me, a theme with staying power. And of course, drones and robotics, there's just a greater need for it, because if you have the spread of a virus that is infecting humans, and especially if you need to send everyone home to control the spread of the virus, the more you can rely on robotics, the more you're able to continue, for example, with an assembly line, that kind of thing. So, and that's just one example, but But drones is a really interesting area because many of the e-commerce companies are thinking about how they can better deliver and how they can bypass utilizing third parties for delivery. So I think that expands as well. Some other themes that I think are just important to talk about: the Great Reset, and that's an economic recovery that is focused on specific areas like ESG and infrastructure. Also, debt overhang. We're in an environment where yield is still relatively scarce. We're likely to see rates remain relatively low. I mean, we've heard from Jay Powell again and again that he's going to keep the Fed funds rate quite low. So even though, of course, the yield curve is steepening, rates are relatively low. It continues to be something of a yield scarce environment. And then, of course, there's going to be a return to globalization. I think as the economies open up, it may be different, and certainly U.S.-China relations, I think, is going to continue to be an issue. But in general, I think we are going to see a return to globalization, and a lot of global consumer trends will accelerate, especially emerging markets, sort of the emerging middle class consumer. So let me stop there and ask John if he wants to ask me any questions, and then I'll just give a quick conclusion at the end.
Will do, Kristina. We have a few great presentations. Always fantastic to hear your thoughts and on the markets, but also on the globe and the pandemic. So and putting it all together. So it's fantastic. A couple of we summarized a number of questions from the audience. I want to throw one out or a few out. Given the tremendous amount of stimulus and the Fed and Congress's openly stated accommodative fiscal and monetary policies for the foreseeable future, what is your outlook on inflation and thereby real interest rates and the U.S. dollar?
That's a great question. So what I would say is that I do think we're going to see a pickup in inflation. I think Jay Powell is right in suggesting that it takes time for any kind of significant increase in inflation. I mean, we've lived through multiple decades of a disinflationary environment. And so, yes, we're likely to see pent-up demand and spending. But at the end of the day, typically what really fuels sustained increases in inflation is a rise in unit labor costs. And that seems unlikely any time in the near term, just because we still have a lot of labor market slack. So my view is that we'll see probably a modest increase in inflation, but we have to recognize that the Fed is very unlikely to react to it. Jay Powell has said, we're going to treat it as transitory, most likely. We're going to let it overshoot because remember, they changed their inflation targeting policy. So they're comfortable letting it overshoot their target for some time. So I don't think it results in any kind of increase in the Fed funds rate for this year. Now, the long end is another thing, right? We've already seen the 10-year rise and actually rose pretty quickly, pretty significantly today. And that was a rapid rise. So we could certainly see market jitters and the long end, the yield rise and fall. I think there's going to be some significant volatility there, but I don't think it results in Fed action. And I would expect that the U.S. dollar remains a bit weak. Very modestly weakened from here. Nothing significant because I think the Fed sits on its hands.
Great, thank you. Next question. There seems to be a disconnect. Another question from the audience. There seems to be a disconnect between the real economy and the stock market. With the stock market being at all-time highs and seems to be accelerating, are we in a bubble?
So great question. And I would say that if we went back to the global financial crisis, you'd see that same disconnect. I just remember how bleak Main Street economy was in the late aughts, but we didn't see that in the stock market. Once the Fed stepped in, we saw the U.S. stock market rip. Global stocks did well, and many worried at that time that there was a huge disconnect. And I think that is part and parcel of extraordinary monetary policy, because it has so much more of an impact on capital markets, on the stock market, than it does on the overall economy. And in fact, I think that is part of what has informed fiscal policy this time around. Remember, fiscal policy, fiscal stimulus was not that significant after the global financial crisis as a percentage of GDP versus what we're seeing this time around. Because I think there's a recognition that to impact the Main Street economy, you need to have more fiscal stimulus, because monetary policy is certainly helpful. You don't want to create more headwinds for the economy, but it largely is most beneficial to the stock market. Now, there's also a school of thought that says that the stock market's just a leading indicator, and where it goes, the economy will follow. And that certainly was true with a very significant lag during the global financial crisis. We just didn't see the robustness of the economic recovery the way we saw the robustness of the stock market rally in those early years. So I think there's a lot of truth to that this time around. I think what we're seeing with the stock market is a function of monetary policy, but it's also an expectation of a strong economic recovery.
Kristina, thank you so much. In the interest of time, we're going to wrap up, but your comments are always insightful, and it's just fantastic to get your perspective. At this time, I'd like to toss it over to Jody Foster, another board member, and she is going to finish us up. Jody?
Thank you so much, John, and thank you, Kristina, for that very thought-provoking discussion. I'm Jody Foster, and I'm a member of the Catholic Foundation Board. And probably like many of you with us today, I was introduced to the Catholic Foundation through the Investment Forum. Even though I'd sat through a few events, though, I really wasn't sure how the Catholic Foundation worked, and I really wanted to get more involved. I come from a long line of Catholic school attendees, and I know Kristina is also a Catholic school girl. And I was really distressed when I saw what was happening at Catholic schools in my home state of New York. My mom's Catholic grammar school in Buffalo is now closed. Her high school, closed. And on the other side of the state, in Long Island, where my siblings and I grew up, our grammar school, now closed. Mercy High School, now closed. In fact, even with Catholic schools leading the way in this pandemic, Catholic school enrollment is down 6% across the US. Could this potentially be our future here in Atlanta and in Georgia? My husband, Jim, and I moved our family twice to send our 3 children to Catholic school, and it's really been a game changer. So we asked, how can we make sure that 30 years down the road, when our children ask about the Catholic schools they went to, that they won't have to say they're closed? How can we make sure that all children and families who value a unique Catholic school environment have that opportunity today? And that's where the Catholic Foundation comes in. If you, or for your advisory clients, if they're thinking about ways to give back today and in the future, the Catholic Foundation offers a wide variety of ways to serve those Catholic schools, those Catholic churches, and those Catholic causes that we hold near and dear. If you have some low basis stocks that are looking at huge capital gains, think about setting up a donor advised fund with the stock through the foundation, and they'll give you a tax efficient way to do this. If you have a coin collection, I used to have one, precious gems, art, the foundation can assist with turning these assets into tax efficient donations. Consider naming the foundation as a beneficiary or part of a beneficiary of your 401k, your life insurance policy, or even in your will. They're excellent caretakers of your donations. And this is a way for you or for your clients to make a lasting impact on the future of Catholic schools, Catholic churches, and Catholic causes. There are many, many ways to make a gift or a donation to preserve this future. Next, I would like to introduce you to Julia Greco, and she's our fabulous director of major and planned giving, and she'll wrap up our meeting.
Thank you, Jody. So yes, the staff at the Catholic Foundation. Oh no. the staff at the Catholic Foundation of North Georgia, and I thank you all for sharing your valuable time with us this morning at our second annual Catholic Foundation Investment Forum. We hope you found the information valuable, and we look forward to our future events in person. Later today, you will receive a survey via email. Since this is our first virtual investment forum, your feedback is especially valuable to us. We will also make the slide deck available to you. The Catholic Foundation Advisors Network brings together estate planning attorneys, accountants, financial planners, wealth managers, and insurance advisors to promote collaboration, education, and leadership in current and legacy giving among their Catholic clients. And we invite you to partner with us. So please go to our website or call us directly if you wish to learn more about this network and join the group. If you are interested in individual or family philanthropy, please reach out to me or Nancy. We'll be happy to discuss our various services with you. And if you are an organization that wishes to grow or establish an institutional relationship with a Catholic Foundation, we look forward to having those conversations too. A very special thank you to our presenters, Father Henry Atem, John Rapole, and Jody Foster. And tremendous gratitude goes to our keynote speaker and friend, Kristina Hooper with Invesco. Whether you are a professional advisor or an individual at a parish, a school, or a nonprofit organization who wishes to make a lasting impact in our community, please call us at the Catholic Foundation. We are here to serve each and every one of you. Everything we do is aligned with our Catholic faith. We're so fortunate to do this important ministry for our Archdiocese. God bless you and have a wonderful rest of your day.